Vice President of Rain Industries Limited, Mr. Gerard Sweeney, President of Rain Carbon Inc., and Mr. T. Srinivasa Rao, Chief Financial Officer of Rain Industries Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. During the conference call, management will be referencing and discussing a slideshow presentation which is available for viewing on our website at www.rain-industries.com in the Investor Relations section. It is recommended viewing this presentation while listening to management's discussion. Before we begin, management would like to mention that some of the statements made in today's discussion may be forward-looking in nature that could be affected by certain risks and uncertainties. The company's actual results could differ materially from such forward-looking statements. Now, if you could turn to slide 3, I would request Mr. Jagan Reddy to provide an update on key developments within the Rain Group. Thank you, and over to you, sir.
Thank you. Good evening to everyone. I hope everyone is staying healthy and safe. Many parts of the world are entering a second and even third wave of coronavirus. This resurgence serves as a stark reminder to all of us that we cannot let our guard down or become complacent. To ensure the health and safety of our personnel and to safeguard the operation of our facilities, we reinstituted some of the strict measures that were in place at the height of the pandemic, including mandating that Rain personnel work from home to the extent possible, limiting travel between Rain locations, and a continued ban on travel except in connection with essential business. A shutdown of any production lines or facilities due to COVID-19 could have a significant impact on our earnings, our ability to meet customer requirements, and our reputation as a company. The safety of our employees will continue to be our top priority as we continue operations during the pandemic. Turning to slide 4 of the presentation. When we entered third quarter, our company and much of the world were hoping for a V-shaped recovery as the global economy began to rebound from the initial outbreak of COVID-19. While we did see some recovery, it quickly flattened. Our third quarter was characterized by an increase in volumes offset by tightening margins. This in part was the result of a change in product mix due to the sell-off of certain inventories accumulated in Q2. Revenues of Indian rupees 25.66 billion for the quarter was an increase of approximately 9% compared to rupees 23.61 billion during Q2, and our adjusted EBITDA of rupees 5.2 billion during the quarter was an increase of approximately 19% compared to rupees 4.3 billion during the second quarter of 2020. Performance improved as the global economy began to return to normal after the near worldwide shutdown during second quarter. Proactive measures taken in second quarter to increase finished product storage capabilities allowed us to wait out the adverse commodity price movements and meet customer demand during third quarter as they restocked inventories. However, during third quarter and even now in fourth quarter, multiple hurricanes have significantly impacted our U.S. Gulf Coast calciners as this seemingly endless hurricane season continues to assault the Louisiana coast. Hurricane Laura made a direct hit on our Lake Charles facility in late August. The Category 4 hurricane and its 150-mile-per-hour winds left much of the region without electricity, sewage treatment, or clean water. This was the strongest hurricane to hit Louisiana in the past 150 years, and our Lake Charles calcination and energy facility suffered a significant damage and has been undergoing restoration after the event. For the past 8 weeks, it has been an all hands on deck at Lake Charles, making needed repairs, and I am pleased to report that we have restarted one kiln as of 22nd October and expect to restart the second kiln as well as production by end of this week. To date, we have lost over 60 days of operating time and approximately 32,000 metric tons of CPC sales, which we could not fulfill from our other locations due to quality or production constraints. Looking ahead to the fourth quarter, the prospects for near-term economic improvement are challenging as demand remains flat and low crude oil prices continue to have a negative impact on our margins. The fourth quarter is also one where our seasonal products see reduced demand as customers manage year-end inventory levels. Finally, during the fourth quarter, we will have an unusual number of plant turnarounds occurring due to delays related to coronavirus, which will impact total plant throughput. That said, on the horizon, there are some bright spots and reasons for optimism once we get to 2021. China's economy is roaring back after being virtually shut down at the beginning of the year due to the COVID outbreak. Outside of China, improved pricing in aluminum is having a stabilizing effect on smelters in North and South America, which should secure volumes for our carbon products. In addition, we are seeing increasing demand for titanium dioxide producers from titanium. In our cement business, there was an increase in volumes and revenue by approximately 26% and 38% respectively compared with second quarter. The sales volumes have improved across all regions where we operate. The EBITDA has improved by rupees 518 million compared to second quarter, mainly driven by high margins and lower costs. With good monsoons in South India, the rural economy should provide strong impetus to the construction activity and thereby the cement demand over the next several quarters. With this business update, I will now turn over the call to Jerry to take you through the industry and other business updates on slide 5. Jerry?
Thank you, Jagan. Good morning, everyone. It is a pleasure to speak with you all again. Turning to slide 5, in the top left corner, we have our carbon segment sales prices and volume. While our CPC volumes were up due to the timing of shipments compared to Q2, CPC prices remained relatively flat. Simultaneously, Q3 saw GPC prices increase due to further reduced availability as refiners cut run rates in the face of continued weakness in transportation fuel demand. Also, as previously mentioned, the busy hurricane season in the Gulf of Mexico intermittently closed many refineries. We believe that, as a result, GPC production decreased by approximately 600,000 tons in a relatively short period of time. At the same time, in an effort to economize during a period of reduced throughput, U.S. refineries have increasingly switched to lower quality crudes, which results in higher sulfur GPC availability. The resulting increased tightness in the anode-grade GPC market is expected to continue, but we are already seeing an uptick in CPC prices in Q4, which indicates we should see a normal adjustment period as prices reset in Q1 of 2021. Looking at coal tar pitch sales, volumes were down due to curtailed aluminum smelting capacity as an aluminum major adjusted its global smelting portfolio to match market demand, and we also saw weakness in the graphite industry. The weakness in demand not only reduced our volumes, but was also the primary driver of reduced CTP prices and margins as well. In terms of other carbon products, this subsegment benefited quarter over quarter from resumed global automotive industry production, following a near halt in manufacturing between mid-March and mid-May. Similarly, demand for tires improved as stay-at-home orders were lifted and people around the world began driving again. From a raw materials perspective, we expect continued recovery in the steel industry to improve availability and secure our ability to maintain raw material supplies at an appropriate price. Moving to the advanced materials segment, we saw strong demand for our seasonal products, continued strength in electric vehicle sales, increased demand from the automotive industry, and some strength in the construction industry. A significant performance improvement we have seen this year was from the closure of our Utrecht facility in the Netherlands. We are benefiting from the consolidation of resins production into our Duisburg facility in Germany, which has increased margins and improved our utilization rates. As a reminder to all, this initiative reduced over $8 million of operating expenses from this business and eliminated some low-margin products from our portfolio. In terms of the aluminum market, LME prices are at their highest level in the past year and a half. In conjunction with that, LME inventories are lower due to strong demand from China, as smelters return to producing value-added aluminum for customers versus standard P1020 for sale into LME inventories. While we saw the announcement of one smelter closing, the threatened closure of another, and a 40% reduction in production at a large anode plant during Q3, we believe these will be to some extent offset by plans to ramp up production at other smelters in the European and Latin American regions. Barring another prolonged COVID shutdown, we believe that aluminum demand and pricing will continue to be strong in 2021. Turning to slide 6 regarding our major projects. As we said in our previous call, our hydrogenated hydrocarbon resins plant in Germany is producing our NovaRes pure water white resins, and we are working with our customers to fine-tune and qualify the resins for their various applications and formulations. We are comfortable with where we are during this early stage of plant operation. During Q4, we expect to resume construction at our facilities in the United States and India that will produce our engineered and value-added anhydrous carbon pellets, or ACP. A comparative study demonstrating the differences in performance characteristics of both calcined ACP and CPC, which was recently undertaken by an internationally recognized carbon laboratory, has been completed, and its findings are in the process of publication. Once production begins at those plants next year, ACP will enable us to turn otherwise inferior GPC into a marketable material that offers energy and emissions benefits to anode producers and aluminum smelters. In addition, the fact that the composition of ACP allows us to utilize fine-sized petcoke particles as a raw material rather than incinerating them during calcination will serve to both improve our carbon productivity and lower our plant emissions even further. Finally, at our new vertical shaft calcination plant in India, we are nearing the end of construction after what has likely been the most challenging era ever in which to build a new plant in India due to the COVID-related impact on the nation's entire workforce. Our aim in designing the plant, with its high carbon recovery rate, emissions cleaning technology, fertilizer byproduct, and electricity generation through waste heat recovery, was to create the most environmentally friendly calcination plant in the world. Further enhanced by the flexibility of the integrated CPC production, our state-of-the-art site will benefit from the ability to convert raw material streams that are normally not suitable for calcination, including those readily available in India, into high-quality products for our global customers. While we complete the final stages of construction and in parallel await further clarity from the Indian authorities on the shaft calciners raw material feedstock, we look forward to the operation of the site, which will be ready to commence production within a few months of mechanical completion. With that, I'll now turn the call over to Srinivas, who will take you through the consolidated financial performance of Rain. Srinivas, over to you.
Thank you, Jerry, and good evening, everyone. It is a pleasure to speak with you today. In the third quarter of 2020, Rain achieved consolidated net revenue of 25.52 billion rupees compared to 29.78 billion rupees in the third quarter of 2019, a decrease of 4.26 billion rupees or 14.3%. This resulted from a decrease in revenue of 3.69 billion rupees or 19.2% decrease from our carbon segment and 1.06 billion rupees or 13% decrease from our advanced material business segment, offset by an increase of 0.49 billion rupees or 20.8% increase from our cement business segment. Rain's consolidated adjusted EBITDA increased by 446 million rupees compared to the prior year. This resulted from an increase in the advanced material segment by 349 million rupees and an increase in the cement segment by 569 million rupees, offset by a decrease in the carbon segment by 472 million rupees. Now turning to the next slide on carbon segment performance. Slide number 8. Revenue from carbon segment was 15.55 billion rupees for the quarter ended September 30, 2020 compared to 19.24 billion for the same period last year. During the quarter, the sales volume decreased by 1.1% and the average blended realization decreased by 18.2% due to the changes in the demand and supply situation in North American markets and competition in the Asian markets, coupled with the changes in the fuel oil quotation and lower demand from aluminum, carbon black, construction and graphite industries, which was offset to some extent by the appreciation of US dollar and euro against Indian rupee by 5.6% and 11.1% respectively. Overall, due to the aforesaid reasons, revenue from the carbon segment decreased by 19.2% in third quarter of 2020 as compared to third quarter of 2019. Adjusted EBITDA of the carbon segment decreased by about 472 million rupees due to the margin pressure. Turning to the next slide on the performance of advanced material. Revenue from our advanced material segment was 7.12 billion rupees for the quarter ended September 30, 2020 as compared to 8.18 billion rupees for the same period last year. During the quarter, there was a 15.3% decrease in volume driven by reduced demand due to the temporary shutdown of few of customer facilities due to COVID-19 and lower demand from rubber, adhesive and construction industries. Volumes were by the closure of our Yuthan facility in the Netherlands. During the Q3 of 2020, the average blended realization increased by about 2.8%, driven by changes in the customer mix, and there was an appreciation of euro against Indian rupee by 11.1%. Due to the aforesaid reasons, revenue from advanced material segment decreased by about 13% during third quarter of CY 2020 as compared to third quarter of CY 2019. Adjusted EBITDA for the advanced material segment increased by 349 million due to the higher realization in engineered products and resins compared to third quarter of 2019, coupled with the appreciation of euro against Indian rupee. Moving on the slide on cement business. During the third quarter of CY 2020, cement revenue increased by about 20.8% compared to third quarter of 2019 due to an increase in realizations by 21.8%, which was partially offset by decrease in volumes by about 0.9% or about 1% as compared to third quarter of 2019. Cement EBITDA increased by 569 million due to higher margins and lower costs. Moving to the next slide on debt. We ended the third quarter with total debt of $1,224 billion, including working capital and other loans of $94 million. Net debt was $1,004 million and based on LTM EBITDA of $267 million, we ended the quarter with a net debt to EBITDA ratio of 3.8x. Despite that ratio being above our target level, we are still comfortable as our average borrowing cost stood at about 5% and we expect it to be remain stable since the floating rate portion of our long-term debt is tied to the Euribor, which is still negative. Cash outflow on our capital expenditure and plant turnaround costs for the 9 months ended September 2020 totaled $122 million, of which $60 million was for our two major expansion projects, hydrogenated hydrocarbon resin plant in Germany and vertical shaft kiln project in Visakhapatnam, India. Referring to the earlier comments about the resumption of activity on our deferred expansion projects and compliance projects that could not be delayed, we expect cash outflows on a full year basis to increase versus previous guidance. Regarding liquidity, we ended the quarter with $208 million of cash in hand and undrawn revolver credit facilities of $111 million. As evidenced by our cash balance, we are preserving cash proactively to be prepared for any unforeseen event. We continue to watch our liquidity position closely to ensure that our ability to access credit lines is not hindered by our performance. With that, I will now turn the call over to the operator for Q&A session. Operator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Gunjan Kabra, individual investor. Please go ahead.
Hi sir, thank you for the opportunity. So just one basic question from my side with respect to aluminium industry and the carbon segment of the company. So we are seeing huge demand from China. One country is going to face lockdown and there's pick up in the demand in another country. So with such different market environment right now, what are the positives that you see in the industry that will continue to drive the profitability and help in maintaining margins going forward, say for next 2 quarters? And what are the problems or the concerns that you see going forward in this environment that you all are taking care of? Like I expected the CTP volumes to be a little on the higher side quarter on quarter, but on the contrary decrease. So what are your views on the industry?
Jerry?
Yeah, thanks for your question. From a macro sense, there's been, our business on both, in the carbon segment, on both the calcined petroleum coke and the coal tar pitch is not necessarily one that's focused on price needing to be at a certain level. We can make money on our products at a high price point, at a low price point. It's all our ability to buy the raw materials at an effective price. The turbulence that we've seen in the market this year with COVID and the resultant lockdowns has left essentially the disruption for the last 2 quarters and then also into the 4th quarter, the disruption of price versus supply, price of our finished products versus supply of our raw materials. We foresee that correcting and stabilizing, as we just mentioned in our comments. So specific to your question on the carbon segment is that we are already seeing the CPC price. While we had less demand, that demand is now stabilized. We are already seeing the demand picking up a little bit and the price of CPC picking up in concert with the raw material price hikes that we've seen. So that's really the only things that we're seeing. Likewise, in the coal tar pitch side of it, we saw some of the closures caused by the disruption in market take demand off, so that we were pushing volumes into a market that didn't want them. We see those volumes now stabilizing, going into next year, and we have the opportunity to reset our raw material prices with higher production from excuse me, the steel industry. And as a result, we can reestablish our margins. So that's where we see the confidence moving forward in 2021, that we'll have more stable supply and demand, and therefore we'll have more stable margins and more traditional margins.
Okay. Thank you so much and all the best.
Thank you. Be safe.
Thank you very much. A request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. Next participant is Viraj Mehta from Q3CY20. Please go ahead.
Yeah, hello sir, and congratulations for good set of numbers in a testing time. I had 2 questions. First, if I look at a broader picture of the company, next year with our expansion coming in, and also world probably normalizing, would it be fair to say, and our no new big capex coming in, would it be fair to say that potentially next year will be one of the best cash flow years for the company, free cash flow year for the company?
I would certainly
comment on. Go ahead, Jared.
Sorry, go ahead, Jared. I guess I would say, sir, thank you for your question. And I would like to hope that that goes from your lips to God's ear. But we can't really comment on forward-looking type of situations. We are seeking to reduce our capex, and we're hoping for more positive market conditions for 2021, and which could help us. But at this point, in a world that's shown us virus and record U.S. Gulf hurricane activity, for now we're looking forward to the end of hurricane season. We just hopefully finished our last hurricane in Louisiana yesterday. We're hoping for the end of this and just let's call it calmer waters and calmer operating environment for 2021.
And I wanted to ask this to Mr. Reddy. Sir, if we look at last few years, we have always come up with capex of north of $100 million, $150 million every year. And I understand we have 60-70 million of recurring capex. But post this expansion, are there any big capex in line for us for next 18 months?
No, there is nothing in pipeline for us. Once we complete the HSCI project completed, and also the shaft calciner project, we have no major capacity expansions.
So that whatever cash flow we will make, is it fair to assume that we will use that in debt reduction?
Yes, because we have no other use for cash, we can actually use it for debt reduction. And starting 2022 March, we will not have any prepayment penalty also on our bonds, so we can actually start prepaying them.
Question is, because our stock today trades at multi-year lows of last few years, has the board considered a proposition for a buyback, please?
See, we are a holding company, so basically our cash has to come in the form of dividend to the holding company. So we have certain restrictions. But once the cash comes in, we can evaluate several things, and we will look forward to it. Thank you.
Thank you so much. Best of luck.
Thank you very much. Next question is from the line of Rohit from Marshmallow Capital. Please go ahead.
Thank you for the opportunity. I would request the management to give please more clarity on when the three new capex projects of ours, which is the HHCR, the vertical shaft, and the ECP project. When do you expect them to start generating revenues for the business?
We expect the HHCR project, it's already commenced operations. So HHCR project should commence operations and revenue should actually, you can see from Q1 2021. And the shaft calciner project, you will see hopefully from, depending on, we are hoping that there's a lot of changes in the government, including new environmental regulations coming in. We hope, and the calciner being the world's most environmental friendly or lowest emissions project in the world, we are hoping that we should get clearance. And once we get that, within this first quarter of we getting the permission, we'll start seeing revenues, because we have actually a lot of demand actually for that product that is coming in. There are a lot of customers that are approaching for that product. And we can actually simply be a import replacement, because India imports over 500,000 tons, and we can actually be an import replacement also. So these two projects, and see, the ACP projects are basically for cost reduction. They are not, we don't sell that product to anyone, but we'll actually be using it as a raw material. But they are to reduce the cost of our production substantially, because it enables us to use low density and the non-traditional materials for which there is not that much demand, or there's good availability for that products in the market. So that is the reason why we think the ACP will help us reduce our raw material costs.
Two follow-up questions to this, sir. So the first one, you mentioned about the environmental clearance for the vertical shaft calcining project. Just a clarification, is it to operate the facility we need an environmental clearance which is not there yet, or is it related to the Supreme Court issue where you expect approval to get to be able to import raw materials because this is an SEZ and it is an environmentally advanced plant that you're referring to?
It is, we already have all the permissions to import. We already have all the permissions to operate the plant. All the environmental clearance have already been received. We're just awaiting the Supreme Court clearance for import of raw materials.
Okay, understood. That was helpful. My last question is broadly, it's a long-term question, sir. If I see from, in 2009-10, the company had a market cap of around 1,500 crores. Cut to today, we are at a market cap of 3,500 crores. Barring a brief period of around 2 years, we have, while the management, I'm a long-term shareholder in the company, and I believe that you have created exceptional value inside the business through your acquisition and capex. But the recognition, given a publicly listed entity, the recognition in the market is not yet there. I just wanted to know your thoughts on, if you have any thoughts on why that is the case, and is there any plans to unlock the value that is in the company or that you have built over the last decade in the future?
So unfortunately, I cannot talk about the stock price, because it's something, all we can do is run the company as well as we can, but to the best of our ability. But I cannot comment on the investor perception for the company, but we always try to do the right thing for the company. That's all I can say. Thank you.
Sure. Thank you, sir.
Thank you very much. Next question is from Rahul Jain from Systematics Group. Please go ahead.
Yeah, sir. Thank you very much for taking my question. So one is, I want to understand your carbon business better. So we've seen a good decline in the inputs for example, fuel oil and other things. But we have and also price has corrected. Going forward, what is your view? So over the next 6 months in terms of how aluminum is shaping up, and what do you think on your margin front? Do we have any linkage to aluminum price on the way we price our product?
Jerry?
Yeah. As our comments indicated, the real positive that we have out there, and something we're all very pleased with, we just need our other circumstances catch up to is that the aluminum price globally is at an 18-month high. And so we really think that with that macro umbrella of positivity over the aluminum industry, that it will continue to firm up the positives. And even the reductions that we've seen will be overcome by capacity increases, essentially ramp up of production in existing smelters. As far as our products are concerned, we are not indexed in any way to the aluminum price. The aluminum price moves off of its own supply and demand factors, but certainly the level of the aluminum price and the health of the aluminum price affects over the long term the amount of production in the world. And it's that amount of production that we rely on to provide demand for really the vast majority of our carbon product segment.
Right. And sir, what kind of market share do we have in this business? And in a sense, would you also give some color on margins? So you think these kind of margins are maintainable in future? Do you have any view on that?
The percent of market share is not easy to express when you consider China, because you can't quite understand exactly what's going on in China. But if we exclude China for the sake of the dark area that it is, at current outside of China, we're currently at roughly a 10% market share globally of the freely traded, coal tar pitch and calcined petroleum coke products.
Right. And sir, just if I may squeeze in, one is that do you sell your products on a contract basis, or is it like a spot market?
No, the overwhelming majority of our carbon products, I assume that's what we're talking about, are on long-term contracts.
With price participation?
Mostly on a quarterly basis.
You have a quarterly price revision. Okay, sir. Thank you so much.
Yeah.
Thank you very much. Next question is from Akhilesh Kumar from AdPro Technologies. Please go ahead.
Yeah, thank you for taking my question. I have one question. In the last call, we were discussing about we have in hand to avail any facilities, relief packages announced in the Europe or any other country. Have we availed anything, or we are planning anything?
So we did actually take one PPP loan from the US at about $6.2 million. So that is the only thing we have taken, because otherwise, since we are operating and our cash flow is comfortable, we did not seek any other loans from the governments, any government-supported loans. This PPP loan actually is a forgivable loan. We are expecting that the $6.2 million we have taken is a forgivable loan. And the US government, we expect them to open up the request for forgiveness for all those loans in the next 1 to 2 months. So then hopefully that should not be payable.
Okay. And I have another query. I think for quarter after quarter, we are still getting stuck into the issue of getting the permission for our raw material GPC. This year also we got, from last year, the reduced amount of permission for GPC. Would that be sufficient enough for running the existing plant itself for the entire year?
Our existing plant, there is no problem. We have sufficient raw materials for running our existing plant. Only for the SEZ plant where we have difficulty getting material. But we are hoping that that issue also should get resolved within a quarter.
Okay. And the last thing what I have been asking every quarter, but I'm getting the same reply. With the cement company valuations and demand supply better, do we have any how long we have to wait to get that cement our business to be demerged again or listed again?
No, we have no plans. At this time, if you see, this quarter actually, cement is the one that actually really helped us. So when global markets are a little turbulent, and we expect the cement business to do well going forward because of the rural economies is going to improve considerably, and our presence mostly is in rural India. So
Yeah.
at this time, we have no plans. Thank you.
Yeah, but it would, like, say, help the shareholders getting the unlocking the value. Like market cap, we will cement itself, we will have around 2,000 market cap.
As we said, we have no comments on that, please. Thank you.
Okay, thanks.
Thank you very much. Next question is from the line of Arvind Kothari from Nivesh India. Please go ahead.
Congratulations on a very stable performance, sir. I had a question related to the lag impact of the prices of GPC and CPC that the viewer alluding to in the opening commentary. So our channel checks has led us to believe that in China actually the CPC prices, because of high operating rates in aluminium, have gone up, but at the same time the GPC prices have also gone up. So are we believing that the next quarter maybe we will have higher GPC prices, the CPC prices will be able to increase only after the next quarter?
Yes, we normally have a 1 quarter lag, at most 2, but mostly it's 1 quarter lag. So we expect Q1 2021 the increased prices can be passed on to the customers.
So the margins that we experience this quarter might suffer in the coming quarter. Is that what the correct assessment can be?
Excuse me?
The margin that we experience close to 22%, 20% this quarter, that might get affected in the next quarter and might again recover in Q1. Is that the correct assessment?
See, again, our business is a little different because we cannot just go by the margins or percentages because our raw materials fluctuate, so will our finished product. The higher the raw material price and the higher the CPC price. But as the numbers keep increasing, the margin actually technically, our number, even let's assume in this market you may make $50 on $200, it may actually look like you're making 25%. And let us say it's $600, you may make $100. The percentage may look very small, but actually in absolute terms you make more money. So the percentage is not a right way to look at it, but we think Q1 going forward, I think the numbers should be better actually.
Got it. Thank you. Another question was regarding the post-COVID. We look at various industries. A very strong emerging trend is that the smaller operating guys are actually facing the heat, and larger players are actually increasing their market share as well as margins. So with respect to our industry, I know China is a great factor, but leaving aside China, what do we see in our other geographies? Is the competition lagging and smaller players, maybe can give way to us in terms of gaining more market share and maybe more higher margins going forward?
We expect to sell, whatever we produce going forward, we expect to sell all our products. So.
Okay. Thank you so much. And my last question would be...
Yeah.
Okay, I'll come back on. Yeah.
Thank you very much. I request to all the participants, please restrict to 2 questions per participant. Next participant is Vikram Sharma from Meraiki Wealth Management. Please go ahead. Vikram Sharma, your line is in talk mode. Please go ahead with your question.
Hello. Yeah, good evening, sir. So my question is, Germany has announced lockdown again. So what will be the impact of new lockdown announcement on our Germany business?
It should not generally impact us because the industry and the trade will continue. As was seen in the first lockdown, there was no impact on the industry or the trade. So we expect the industry to continue to run in Germany.
Okay. And sir, another question is, with the shutdown of one facility in Netherlands, and we are also starting our new facility in Germany. So what will be the total change in employee cost and total operating cost with these steps? And what will be the sustainable cost reduction in employee cost and operating cost from the shutdown of our Netherlands facility?
It's about $8 million per annum.
Saving.
That's correct.
$8 million. Yes.
Can we move to the next question?
Thank you very much. Next participant is Pratiksha from Equirus Small Finance Bank. Please go ahead.
Hello?
Yes, please.
Go ahead.
Yeah. So, you mentioned that the total capex incurred till this YTD is about $122 million, and out of that, 60 is towards the balance, the two projects that are going on. So, is it correct to assess that the balance is maintenance capex, and there'll be no further maintenance capex for this year?
See, basically, we actually incur about $65 million as maintenance capex each year. So that is where we are limited. So.
Okay. So basically, we've incurred the maintenance capex for the year.
We think so. More or less, we are. But as we said, the Hurricane Laura has actually damaged quite a bit. So basically, we are incurring costs towards that. But we do expect to get insurance for that. So there'll be some deductibles and other things that may impact. But overall, we expect that the maintenance capex will be about $65 million plus minus.
Okay. And, we've been seeing last 2 quarters, the depreciation, the quarterly depreciation is seeing a steady rise. The accelerated depreciation that we were to see because of our restructuring is already recorded. And so what would be this increase in depreciation attributable to?
Because of the lease accounting. It's about $1.5 million per quarter. So on an annual basis, about $4 million. Incremental depreciation on account of the new lease standard we introduced.
Okay. And one last question. So I think earlier we had mentioned that HFCR plant would start contributing to revenues Q4 onwards. So are we seeing any delay there, or is there a new development on that front?
There is delay by a quarter because of this COVID, because of the traveling of technicians and other things is becoming a little difficult. And we have had little couple issues, basically during startup, but there's a quarter of a delay by a quarter. That's what, as you said, you can see revenues flowing in from Q1 in 2 months. But we are already supplying, test quantities. It's not that the plant is stopped. We are supplying quantities to customers.
Okay. Thank you. Thanks.
Thank you very much. Next question is from Viraj Mehta from Q3CY20. Please go ahead.
Yeah, sir. Just one last question regarding the ACP commencement of ACP plant. If on an average we were making, let's say, $75 per ton as our margin, and just a theoretical example, post this ACP, how much will the margin? Will it be $10, $15? Will it be $40, $50? Just wanted to understand the delta this will bring into our.
See, we cannot talk about particular margins, but I'll tell you how it works. See, a good raw material, say, I'm just going to give a couple of hypothetical issues, is that if we actually take a good quality material, say, at $100, then inferior grade quality may be $50. So, but we cannot process the $50 material because the calciner will have difficult time processing it. But what happens in an ACP plant is we can actually take this $50 material, screen it. The coarse material actually directly goes to the calcination, and all the fines, almost 30-40% of the product actually can be used to make ACP. So basically, you are actually maximizing the usage. But at the same time, you are bringing down the consumption of the overall material. So because of that, the density and other things improve. So it does add quite a bit value from that perspective. So your ability to use inferior grade quality of raw materials will increase quite a bit.
Sure, sir. And how much money did we spend on this ACP plant?
The ACP plant actually in US is costing us about $22 million.
Understood. Thank you, sir, and best of luck.
Thank you.
Thank you very much. Next question is from Rakesh Vyas from HDFC Mutual Fund. Please go ahead.
Yeah, hi, good afternoon. I have a few questions. First, can you just highlight as to what will be the capex outflow in calendar year 20 and 21 based on what projects you already in hand?
See, the capex outflow in 2020 will be somewhere about $135 million, total including maintenance capex.
And calendar 21 would be how much? The pending capex for the ongoing project and let's say 65 cents.
Including the only project that will be there will be ACP project in 2021. So it will be that because since we are substantially already completed the cost, we have very nominal cost on it to be invested at least in the US plant. So we think a total including maintenance capex next year may be about $75 to $80 million.
Okay, that helps. Secondly, can you just highlight as to what is the current issue with respect to the vertical shaft in India? You highlighted it's only the Supreme Court clearance that is pending for import of the raw material. All other clearances are already in place. Is that correct understanding?
Yes, please. We have all the approvals in place, so we just require Honorable Supreme Court's permission to import. But we have certain advantages also is that, first of all, this is the environmentally most best plant in the world. And second advantage is being the SEZ plant, we have certain special permissions. So all we need to do, so basically we need to get the clarification from the Honorable Supreme Court that in accordance with the SEZ rules, we can actually import materials. So we are hoping that we should get something in the next quarter or so.
So correct my understanding. I thought earlier plan was to import material and because it is part of SEZ, use it to blend and sell it globally as well, especially Middle East, etc. Even in that context, you still need a lot of clearances in importing material, is it? If it was supposed to be for domestic market?
It's just Supreme Court clearance, please. It's not other clearance. It's just Supreme Court clearance. We have all the other approvals. It's just Supreme Court clearance because it is the highest court in the country. So the government also is looking for their guidance in giving the approval. Though it's an SEZ and we are permitted to technically to import even prohibited items also into the country. But government also is looking to the guidance of the Supreme Court, Honorable Supreme Court.
Sure. And finally, sir, if you are successful in doing a reasonable cost saving through ACP, what is the further scope globally for you in general to expand this particular framework?
See, once we complete the plant in the US and in India, once we start using it, as you are aware, a lot of aluminum smelters are talking about the green initiatives and green aluminum metal. And if you want to get there, you basically have to reduce your carbon footprint. And ACP actually helps reduce the carbon footprint. So that is one thing. And also when we are making calcined petroleum coke, you are actually, especially in our plants, in both in India or our plants where we have cogeneration, you are actually reducing the overall carbon footprint because you are actually replacing the burning of fossil fuels in thermal power plants. So it actually, and sulfur dioxide are also coming down. So it actually, this plant actually reduces the overall environmental footprint actually in India actually. Similarly around the world. So ACP also further helps that. So from an environmental perspective, it's more sustainable. As days, more and more people are becoming more environmentally aware, it becomes more sustainable business.
Thank you very much. Sorry to interrupt you, Mr. Vyas. I'll request you to come back in the question queue for a follow-up. Next participant is Sriram Ramdas from Green Portfolio. Please go ahead.
Hi, sir. I've just got one question. With the anti-China sentiments, are we seeing any engagements with new customers due to this factor? Maybe in the CPC or cement, etc. Thank you.
Can you come back to the question, please? I couldn't listen.
Sriram, may I request you to repeat the question a bit louder?
Sure. With the anti-China sentiment, are we seeing any new engagements with new customers due to this factor, because of anti-Chinese sentiments? May it be for CPC or cement or advanced materials. Thank you.
There's nothing called anti-China sentiment, but the issue is government of India is promoting more and more of Make in India initiative. So they are trying to see, whatever can be produced in India can be consumed here. So I think that will be a great initiative going forward. But as we said, because there is a shortage of green petroleum coke in India, so products like ACP that enables us to use the available inferior grade quality material is actually permits us to increase the India content. For example, the Indian public sector aluminum companies actually have already put in a requirement that the preference will be given, where the consumption, if you use 50% or more of Indian raw materials in the manufacture of CPC. So plants like ACP will help us actually to get to that 50% or more. So, but we are not, there's nothing called, there are restrictions are to import from China, but only one thing is there is more of Make in India initiative.
Oh, perfect. Thank you very much, sir. Thank you.
Thank you very much. Next question is from the line of Arvind Kothari from Nivesh India. Please go ahead.
Sir, I wanted to ask about the cement capacity utilizations. What would they be currently, and what are we planning next year? Because of the factors that we are seeing, our competitors like Sagar and all also reporting excellent EBITDA and utilization numbers.
Yeah. So basically, utilization is about 60%. I would say 60-65% capacity. But what is helping the prices is the logistics capability, because initially the logistics was what was helping, because transportation over longer distances was difficult. So that's the reason why margins have improved. But now I think this prices look sustainable because the demand is increasing, and as the cement companies slowly ramp up production, still should be able to sufficient to meet the increasing demand.
Okay, great. And sir, regarding the vertical shaft calciner, in the earlier calls, we were confident that we would be utilizing local material also to start the plant. Now, are we taking another view that we'll be waiting for the approval, or if there is delay, will we be going ahead and starting the plant with the locally available material?
See, what has happened was, due to the COVID, it has actually changed certain plans, because we were actually planning to complete both the shaft calciner and ACP plant simultaneously. But because of the COVID, our manpower or the skilled manpower available at the site for construction has come down below 50% than what was there during peak. So because of that, we actually had to stage the construction. So our target was to complete the shaft calciner first and put ACP plant on hold. So we are nearing completion of the shaft calciner, and once that is done, then we're going to start taking up the construction of the ACP plant. So once the ACP plant starts, then we can actually start using that will take about 6 months to complete. So till that time, but simultaneously we are also working on our ability to import material. So we will have both the options.
And the operating rates in China in particular for aluminium have been going up. Are we experiencing the same thing in Europe and US maybe and India? Is there a lag demand kind of impact, or there is some higher demand which we feel is sustainable?
Jerry?
I'm sorry, I didn't catch the question.
My question is that the operating rates of smelters in China has been going up, and they are also importing material, in large quantities for the first time. So going ahead, do we feel that it will have a trickle-down effect in other geographies that we operate mostly in US, Europe, and maybe in India?
Yeah, China is self-contained. So as far as the impact that China will have on us, the products that they're importing are more the raw materials for aluminum production, but their carbon is pretty self-sustaining. What it can do to help us is essentially they'll be more reliant on their own supply and export less product. That will help the markets outside of China, particularly in South Asia as well as in North America. So that's really the only potential impact or benefit that we would see with increased production. But I would agree with you that aluminum production in China is continuing to grow. Their economy is now booming, where they've locked down and they're living with the virus, so to speak. So it can have a beneficial effect for us in 2021.
So are any clients engaging us for their expanded capacities or high working rates, or you're hearing anything from your maybe an also Q2 or anyone who's wanting to ramp up maybe?
In China?
Which you are supplying to, are they giving you feelers for high operating rates next year? So maybe we start preparing for that currently.
I'm sorry, are you talking about China or anywhere in the world?
Anywhere in the world. I mean, particularly our clients, like maybe Alcoa or not so Q3, are those guys telling us that they're preparing for high working rates from next year and hence they would want us also to supply more material?
Some customers are expected to run at higher operations, yes.
Thank you very much.
See, basically what is happening is the imports from China have come down, both green petroleum coke and calcined petroleum coke. So basically the customers are looking for more material from other suppliers. That includes us. And so that's why we think in 2021 will be more bullish compared to 2020.
Thank you very much.
Thank you.
Ladies and gentlemen, that will be the last question for today. I will now hand the conference over to Jagat Reddy sir for closing remarks.
Thank you. During the third quarter, we saw the global economy begin to reopen and demand for our products increase in July and early August. However, that uptick in activity flattened as the quarter ended. We are now looking at a fourth quarter that could be partially impacted by a resurgence of coronavirus. The good news, if that's an appropriate phase during this turbulent time, is that our company is well positioned to ride out another COVID wave. Throughout our operations, we are doing everything we can to keep our people safe and our plants running so we remain a strong link in the global supply chain. We are also continuing to carefully manage our costs and capital expenditures while constantly looking for ways to turn what we have learned and how we have adapted during the COVID pandemic into competitive advantages. Moreover, once the world returns to normal, we are poised to capitalize on the investments we have made in our major projects, including our hydrogenated hydrocarbon resins facility in Germany that will enable us to meet growing demand for cleaner resins from packaging and adhesives industries and serve as a cornerstone of our advanced materials business. Our vertical shaft calciner in India that will be the most environmentally friendly plant of its kind in the world while facilitating a high carbon recovery rate and waste heat electricity generation. And our anhydrous carbon pellet production facilities that will enable us to create an engineered and value-added alternate to CPC that will offer energy saving and emission benefits to anode producers and smelters. Finally, we will be closely monitoring the global response to the results of next week's presidential election in the United States. While there could be a range of unpredictable reactions in the coming months, we are optimistic that business conditions will improve next year, COVID notwithstanding. These are uncertain times, to be sure. But one thing you can be certain of is that Rain is laser focused on doing what is necessary to meet the needs of our customers and fulfill the expectations of our shareholders, employees, and the communities where we operate. Thank you for joining us today, and I hope you and your families remain healthy and safe until we speak with you again in early 2021. Thank you all.
Thank you very much. On behalf of Rain Industries Limited, that concludes this conference. Thank you for joining us. You may now disconnect your line. Thank you.
Playback is complete.